Hi, I want to welcome everyone participating in today's webinar, SAS number 134 to 141, New Auditor Reporting Standards. My name is Tom Shields, and I'm an audit supervisor here at GRF CPAs Advisors, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you need to do to earn the CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically following the webinar. You'll be asked to recall these words in order to receive credit. Please write down the CPE words when they are given and keep them until you receive your certificate. They will not be provided again. If you have any technical questions or issues during the discussion, please use the questions function to speak with our administrator for assistance. The slide deck and recording from today's discussion will be available on the event page on our website. Technical support and CPE questions may be addressed to Nathan McElveen at grfcpa.com. Today's learning objective is to provide attendees with industry updates and guidance for new accounting standards under SAS 134 through 141. I will now introduce our speakers for today's webinar. Max Manley is a senior manager in the audit department. He coordinates and oversees 40 to 50 audit engagements annually for a wide variety of the firm's clients, including associations, charitable organizations, employee benefit plans, and government contractors. John McIntosh is a manager in the audit department. As an audit manager, he's responsible for managing staff and ensuring that his audits are completely accurate and in an efficient manner, as well as drafting audit reports. I will now turn the presentation over to our speakers.
Good morning, everyone. My name is John McIntosh. Thank you, everyone, for attending. Today, we'll be discussing a new suite of upcoming Statement of Auditing Standards issued by the ASB. Those are SAS numbers 134 through 141. These 8 standards were originally released throughout 2019 and early 2020 and primarily pertain to overhauling the independent auditor's report. I'll be covering the effective dates and go through the details of SAS 134. And my colleague Max will take us through some of the more important details of SAS number 135 through 140. Initially, the effective dates for SAS 134 through 140 were for fiscal years ending on or after December 15th, 2020, meaning that this standard would have been effective for calendar year audits ending December 31st, 2020. However, in May 2020, as a result of the COVID-19 pandemic, the Audit Standard Board issued SAS 141, which delayed the effective dates for all standards by 1 year, making the final effective date for the fiscal years ending on or after December 15th, 2021. So what does that mean for your organization? If you have a fiscal year that ends December 31st, 2021, your 2021 audit report will reflect the new standards. And finally, the board states that all standards must be implemented simultaneously as a suite, since some of the later standards override parts of the earlier ones. Most of my presentation today will relate to SAS 134, but I'll briefly walk you through introductory to each of the other standards in the suite, since they'll all be related and affecting us at some point once they're implemented. Our first standard, SAS 134, is entitled Auditor Reporting and Amendments, including amendments addressing disclosures in the audit of financial statements. This is the most significant standard in the suite, and this standard is intended to overhaul the presentation of the independent auditor's report and aims to enhance the communicative value and relevance of the report. Some specific changes include reordering the sections of the report, including placing the auditor's opinion at the front of the report, providing transparency into the basis for opinion paragraph, enhanced reporting related to going concern, expanded description of the auditor's responsibility and clarifying the responsibilities of management and the auditor, and also disclosure of key audit matters, also referred to as CAM, in the report. This standard and a number of the others are largely intended to align the US generally accepted auditing standards with the current international standards under the IAASB. Our next standard is SAS 135 and is titled Omnibus Statements on Auditing Standards and is intended to more closely align the Audit Standards Board guidance with that of the PCAOB, primarily when it comes to AUC Section 260, communication with those charged with governance. SAS 136 is entitled Forming an Opinion and Reporting on Financial Statements and Employee Benefit Plans Subject to ERISA. This standard will have a significant impact on the employee benefit pension plan audits, and similar to 134, 136 is designed to overhaul the components of the pension plan reports and disclosures. SAS 137 is the auditor's responsibility related to other information included in the annual reports. As the name suggests, this standard defines our responsibility as auditors related to a client's annual report when it contains additional information rather than just the audited financial statements. This brings us to our first polling question.
So for the first polling question, which of the following is not changed by the upcoming audit standards? A, expanded description of the auditor's responsibility. B, swapping the term unmodified with the word clean. C, aligning the U.S. audit report with the current international presentation. Or D, disclosure of key audit matters in the report. Please take a moment now to answer. While participants are submitting their answers, I'll provide the first CPE word. The first CPE word is report. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the first CPE word is report, R-E-P-O-R-T.
All right, it looks like our answers are in. Most people selected B, and that is the correct answer. The new standard will not be swapping the term unmodified for the word clean. And I'll also note that this polling question, all the others are which of the following is not. So the incorrect answer is the correct answer. Okay, moving on. The remaining standards 138 through 141, which we will only briefly touch on. SAS 138 is amendments to the description and concept of materiality and seeks to align the definition of materiality that's used by the Audit Standard Board and the international standards with the definition of the US judicial system, the PCAOB, the SEC, and the FASB. SAS 139 and 140 are basically detailed amendments to the main standard 134 and address some special considerations such as audits under special purpose frameworks, audits of financial statements and specific elements. And I'd also like to highlight one component of 140, and that is revisions for reporting consistency with the uniform guidance, changes to the OMB compliance supplement, and the most recent issuance of the Yellow Book. Our final update is SAS 141, and this standard was issued to announce a 1-year delay in the effective date of all the previous standards, as I had mentioned before. All right, moving on and turning back to our most significant standard, that is SAS 134, Auditor Reporting and Amendments. This standard was originally released by the board in May 2019. And as we know by now, the standard aims to overhaul the independent auditor's report and converge with the international presentation standards. Before writing the standard, the board took a poll of the various financial statement users to see what report information was considered the most useful to the actual users of the reports. Users said that they wanted reports to be more customized to the individual auditees, which really opened up the possibility to make the report itself more of a value-added service and less of a boilerplate template in front of the financial statements. The standard writers also wanted to clearly convey the overall auditor objective. That is, of course, to form an opinion on the financial statements based on an evaluation of audit evidence obtained, and to clearly express an opinion on those financial statements. Ultimately, the standard writers achieve this by reordering the report paragraphs and adding additional information. The most notable change was moving the auditor's opinion to the front of the report for enhanced visibility from the back of the report where it is currently located. On our next slide, we have an image of the current auditor's report that we all know. And of course, the current order of the paragraphs is first stating that we've audited the financial statements, followed by management's responsibility of the financial statements, followed by the auditor's responsibility. And then finally, you can see that we have the opinion paragraph down here at the bottom. The new report format is a little too long to fit on one page, so we've kind of broken it up with different snippets on several slides. And this is an image of the beginning of the new report. The opinion paragraph is now presented first in an effort to immediately let the users know what the most important information is. This way, they don't need to dig through multiple paragraphs to see if a clean opinion was issued on the financial statements. You can also see that the "we have audited" paragraph will now be part of the opinion paragraph rather than on its own as it had been in the past. Our next slide, we have the next paragraph will be a basis of opinion paragraph. And under the current model, the basis of opinion paragraph is only included in the report if a modified opinion has been issued. However, going forward under the new standards, this paragraph will now become standard to all reports. And if you read the template here, it mainly directs you to the auditor's responsibility section, but also states that we're required to be independent of the client. Currently, our reports do not state that we're independent except for in the report title itself, which is Independent Auditor's Report. This section will also state that we must follow our ethical requirements in reference to the AICPA Code of Professional Conduct, the state board's codes of conduct, as well as any applicable regulatory agencies. For example, the Yellow Book framework on threats and safeguards. You also have the option here to customize the section and state any other regulatory agency requirements that you're following. This paragraph will also indicate that the auditor believes that evidence obtained is sufficient and appropriate as a basis for the opinion. This takes us to our second polling question.
Okay, for the second polling question, in the new reporting format, which section will follow the opinion? A, the auditor's responsibility, B, the basis for opinion, C, key audit matters, and D, management responsibility. Please take a moment now to answer. While participants are submitting their answers, I'll provide the second CPE word. The second CPE word is update. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the second CPE word is update, UPDATE.
Okay, it looks like the polling results to question number 2 are in, and the majority of people said that the section following the opinion is the basis for opinion, and that's correct. In the new reporting format, the opinion paragraph will be followed immediately by a basis for opinion paragraph. All right. Following that, our next section is the responsibilities of management. This section is fairly similar to how it currently is presented under the current model, and it states that management is responsible for the preparation and the fair presentation of the financial statements and the design, implementation, and maintenance of internal controls. A new change is that the second paragraph now states that it's management's responsibility to evaluate their ability to continue as a going concern. This is a key difference from the old version of the report, as the going concern valuation is now explicitly assigned to management. Based on my research, there are some people that aren't happy that the words substantial doubt and going concern will show up in the report, even when there is not an issue. So it's advised to let all users of the financial statements know about these changes ahead of time so that they can be prepared. Our next section is the auditor's responsibility. This section has undergone the most significant changes and is now so long that we've broken it up here onto multiple slides. It begins with the typical statement that the auditor's responsibility is to obtain reasonable assurance that the financial statements are free from material misstatement. Based on the ASB's user polling, it turns out that most typical financial statement users were actually not familiar with the terms and definitions of reasonable assurance and material misstatement. So the remaining part of this paragraph is used to explain and define the terminology in more layman's terms. It states that reasonable means high, but not absolute assurance, to let people know that there's no guarantee that the financial statements are 100% free from misstatement. The paragraph then goes on to address fraud risk and state that the risk of not detecting a misstatement due to fraud is higher than one resulting from error, since fraud can be the result of collusion, management override of controls. Again, a good idea to let the users of the financial statements know of these changes ahead of time, since words like fraud, collusion, and forgery will now be part of the standard auditor's report in this regard. But in reality, the goal is just to let the users know that misstatements resulting from fraud are harder to catch because they're purposefully concealed. This paragraph now also gives a definition of the term material misstatement. It states that misstatements are considered material if there is a substantial likelihood that individually or in the aggregate, they would influence the judgment made by a reasonable user of the financial statements. Our next slide is a continuation of the auditor's responsibility paragraph. As you can see, it'll now include some specific bullet points on the GAS requirements, the generally accepted auditing standard requirements that the auditor has followed in performing the audit. These include exercising professional judgment and maintaining professional skepticism throughout the audit. Following a risk-based approach and responding on a test basis. Obtaining an understanding of the organization's internal controls. However, it notes that no opinion is expressed on the effectiveness of those controls. Our next slide is a continuation of the auditor responsibility bullet points. This section also states that the auditor is responsible for evaluating the appropriateness of management's accounting policies and significant financial statement estimates. And finally, to conclude on the entity's ability to continue as a going concern. The auditor's responsibility section now ends here with some AUC 260 requirements regarding communication with those charged with governance. And it notes some things that are currently being communicated in our AUC 260 letters, such as the planned scope and timing of the audit engagement. This brings us to our third polling question.
And for the third polling question, which of the following is not included in the new auditor responsibility bullet points? A, exercising professional judgment and professional skepticism. B, following a risk-based approach and responding on a test basis. C, reviewing client account reconciliations for reasonableness. Or D, obtaining an understanding of the organization's internal controls. Please take a moment now to answer. While participants are submitting their answers, I'll provide the third CPE word. The third CPE word is risk. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the third CPE word is risk, R-I-S-K.
All right, looks like the overwhelming majority of people chose C, reviewing client account reconciliations for reasonableness. And this is the correct answer. Reviewing client account reconciliations will not be explicitly listed in the auditor's responsibility paragraph. However, the other three items listed here will be. All right, the final section here is the close of the report. And if applicable, this is where you would note the nature of any additional legal or regulatory reporting requirements. Otherwise, the report ends with the audit firm signature, city, state of issuance, as well as the report date. Now that the opinion paragraph has been moved to the beginning of the report, there's no other clear conclusion to the report in the template, which some critics have taken issue with, aside from what's noted here. However, it's worth noting that based on the expanded sections, the auditor's report will no longer fit nicely on one page. It will most likely be about 1.5 pages to 2 pages, depending on what is included in the report. All right, another big area I'd like to discuss is on AUC 701, and this introduces the concept of communicating key audit matters, or CAM for short. I believe that this will be a very hot topic once the standards are adopted, because the concept of CAM really creates the opportunity to add additional value to the audit report. The auditor will now have the ability to disclose the most important things identified in the audit and note them on the face of the financial statement report in the form of CAMs. This was the Audit Standard Board's way of making the report more customized to the individual entities. However, when dealing with private companies, generally accepted auditing standards will not require the communication of CAM, and it should only be included when the auditor is engaged to do so. Therefore, an audit engagement letter should be modified appropriately. And if during the audit engagement, the decision to disclose CAM is changed, a modified engagement letter will be required. On our next slide, we have some examples of when CAMs should not be used. Communicating key audit matters is not a substitute for any required disclosures in the financial statements. It is not a substitute for issuing a modified opinion. It should not be used for communication of substantial doubt about an entity's ability to continue as a going concern. And also, CAM should not be communicated at all if an adverse or disclaimer of opinion is issued by the auditor. And on our next slide, if you are disclosing CAM in the audit report, this is kind of a sample of what it could look like. And according to the guidance, this section would come right after the basis for opinion paragraph and right before the management responsibility paragraph. And based on the guidance, the auditor would first include a definition of CAM, noting that these are matters that were of the most significance in our audit. And the individual key audit matters would then be listed here in bullet point format. Examples of CAM would be matters that took significant auditor attention, that were very time-consuming, difficult, or complex, or areas related to management subjectivity, or areas that were very challenging to obtain audit evidence over. It should be worth noting that CAM can only relate to current year matters, not prior year or subsequent year matters. It should be entity specific and not boilerplate in nature. And noting key audit matters is already permitted under the PCAOB reporting requirements, as it has been for the last several years. And based on current PCAOB reports, it seems to be that about 2 or 3 CAM items seem to be the most typical. All right, this brings us to an end of our section on SAS 134. I'll turn it over to my colleague Max Manley to discuss the remaining standards.
Thank you, John. As John mentioned, my name is Max Manley. I'm a senior audit manager here at GRF, and I am going to introduce you to the remaining updates within the new audit reporting suite of standards, beginning with SAS number 135, Omnibus Statements on Auditing Standards. So the overarching theme of this standard is to more closely align the practices and requirements of private entity auditors with those of public company auditors in three main areas: the auditor's communication with those charged with governance, related party and significant unusual transactions, and the consideration of fraud in a financial statement audit. So the goal is that more closely aligning these sets of rules will yield increased audit quality by eliminating unnecessary differences between guidance of the Accounting Standards Board and that of the Public Company Accounting Oversight Board. Now, as we go through these standards, we want to examine what the impact is going to be on management and on the auditors. In the case of SAS 135, the impacts are very closely related, so we can look at them simultaneously. As it pertains to the communication of the auditors with those charged with governance, and that's referring to the boards of directors, the audit committee, or another governing body, that communication takes place in the form of formal written communications, both at the commencement and conclusion of the audit process. And it could also take place during the course of an audit through more informal means or conversations between the auditor and members of governance. Under SAS 135, there will be some new items that are included in those formal communication letters around a couple of things, including significant unusual transactions, difficult or contentious matters for which the auditor consults outside of the engagement team, and uncorrected misstatements, particularly those that could have a material impact on future period financial statements. Other impacts related to this new standard are changes to the audit procedures, specifically around significant unusual transactions and related parties, and predominantly in the form of new inquiries, but not necessarily limited to that. On the next slide, we'll take a closer look at the auditor's communications to governance around significant unusual transactions. So first, what do we mean when we talk about significant unusual transactions? These are transactions that are outside the normal course of business or that otherwise appear to be unusual due to their timing, size, or nature. Some examples the SAS provides of such transactions are things like complex equity transactions, restructuring of ownership, mergers and acquisitions, and the like. They could also be transactions with overseas entities that have less well-defined corporate governance structures, transactions that involve leasing of premises or rendering of management services to another party without any consideration being exchanged, potentially sales transactions where there are large discounts or significant returns, transactions that involve circular flows of funds, so payments that are made to one entity that ultimately revert back to the paying entity, or potentially transactions under contracts that have frequently changing terms. Now, the identification of significant unusual transactions is subject to auditor's judgment, but again, it's generally going to include transactions that are either large, non-recurring, outside the normal course of business, or any combination of those three. Now, if there are identified significant unusual transactions, the auditor's communication to governance will include the auditor's views on the policies and practices that management use to account for these transactions, as well as a description of the business purpose of those transactions as understood by the auditor. Next, we'll look at another new item to be included in the governance communication: difficult or contentious matters. What could be considered difficult or contentious? Again, this would be subject to auditor judgment, but generally this includes matters for which the auditor consulted outside the engagement team and that are, in the auditor's judgment, significant and relevant to those charged with governance regarding their responsibilities to oversee the financial reporting process. Some examples might include issues that are complex or unfamiliar, something for which the auditors had to consult outside experts, could refer to estimates that are embodied within the financial statements where there's a high degree of uncertainty with regards to the outcome of the estimate. Could also be transactions or situations that represent significant risks to the organization. An important one is any limitations that could be imposed by management on the conduct of the audit procedures, or limits placed on access to information or personnel that are requested during an audit. Or it could be just significant instances of non-compliance with laws or regulations that the entity is subject to, including those of contracts or grant agreements. I think this requirement is similar to the current requirement for auditors to communicate significant difficulties that are encountered in performing an audit. And similar to that requirement, if there's no difficult or contentious matters identified, there may be a statement included to that effect in the governance communication. The third item that will now be new to the governance communication is additional context around any uncorrected misstatements that are identified during the course of an audit. Under the current guidance, auditors are required to accumulate and evaluate misstatements that are identified during an audit. If the auditor determines that misstatements that are not corrected are immaterial, both individually and in the aggregate, they will be classified as uncorrected misstatements. Now, if you have an uncorrected misstatement, under current guidance, the auditors need to communicate that those misstatements exist and what their potential effects are to the current and prior period. The big change is that under the new guidance, auditors are also going to include an evaluation of the potential effects of these uncorrected misstatements on future period financial statements. Specifically, a statement that even uncorrected misstatements that are immaterial to the current year financial statements or their underlying causes could result in material misstatements to future period financials. I think the takeaway from this is that there's now going to be more emphasis on correcting all misstatements that are identified during the audit, regardless of their size. Even if they're deemed to be immaterial to the financial statements under audit, we want to avoid the possibility that they may yield misstatements in the future, and we want to avoid making a statement like that if possible. So the best thing to do is correct all misstatements as they are identified. Moving on to briefly look at some of the additional inquiries that will be made by the auditors under the new standard. Auditors will now specifically inquire about whether there have been any significant unusual transactions during the audit period and gather information about the nature, term, and business purpose of those transactions, and also whether they involved any related parties. If those significant unusual transactions are identified, the auditors will inquire about the internal controls related to those transactions and any other arrangements pertaining to arrangements outside the normal course of business. These inquiries will be made not only of management, but also of those charged with governance as well. The auditors will also be expanding their inquiries around related parties, including inquiring as to why a particular transaction may have been made with a related party as opposed to an unrelated party, and asking for justification for any related party transactions where the established policies and procedures for authorization and approval were not followed. Auditors will also be inquiring with those charged with governance about their understanding of related party transactions and the relationships, and whether they have any concerns about those, and if so, getting into what the nature of those concerns are. So a more open line of communication between the auditors and governance around related parties. The last point to cover on SAS 135 is the auditor's consideration of fraud. So under the new standard, auditors are now going to specifically have to evaluate whether significant unusual transactions or related party transactions could be indicative of fraud. The SAS does offer some examples of potential indicators of fraud related to these transactions. It could include transactions that are overly complex, things that have not been discussed with the board or the audit committee, transactions that have inadequate supporting documentation, transactions that may be entered into with the goal of achieving a particular accounting treatment without regard to the substance of the transaction. And they could also be transactions with related parties that have not been reviewed and approved by governance, or potentially with related parties that were previously undisclosed. Next, we'll move on to SAS 136, forming an opinion and reporting on financial statements of employee benefit plans subject to ERISA. So the Department of Labor reviews audits of employee benefit plans on a regular basis. And during those reviews, they have found a number of deficiencies recently. And so this standard is an effort to address their findings, as well as to add clarity within the auditor's report about the responsibilities of management and the auditors for the financial statements. So it is similar to SAS 134 in that a major component of the update includes revisions to the audit report. In terms of impacts on management, the most significant changes are requirements for management to formally affirm in the engagement letter, the client representation letter, and in the auditor's report itself, certain of their responsibilities, including their responsibilities for maintaining a current plan document, including the amendments, the responsibility for administering the plan and determining that the plan's transactions are presented and disclosed in the financial statements in accordance with plan provisions, and for maintaining sufficient participant records to determine benefits due under the plan. Continuing on the next slide, when management elects to have an ERISA Section 103A3C audit, formerly referred to as a limited scope audit, and I'll touch on this a bit more on the next slide. If it is having this type of audit, management must affirm that the audit is permissible under the circumstances, that the investment information is prepared and certified by a qualified institution, and that the certified information is appropriately measured, presented, and disclosed in accordance with the applicable financial reporting framework. Finally, management must provide the auditors with a substantially complete copy of the Form 5500 prior to the auditor's report being issued, including the supplemental schedules. Now, typically this does already take place under the current environment, but it is now a requirement that that 5500 be completed before any audit report can be issued. In terms of impacts on the auditors, the biggest impact is the change from a limited scope audit and that concept to a new type of audit, which is referred to as an ERISA Section 103A3C audit. So these are audits where auditors do not perform audit procedures over the investment information, the investment balances and the related income, because it has been certified by a qualified institution. Qualified institution refers to a bank or similar institution or an insurance carrier. Now, under the previous guidance, when auditors would conduct a limited scope audit, the auditors would issue a disclaimer of opinion on the financial statements. Now, that is no longer going to be the case. The entire audit report has been overhauled. So now it's going to begin with a section describing the scope and nature of the ERISA Section 103A3C audit. This section is going to state that management has determined the audit to be permissible and that as permitted, audit procedures need not extend to any statements or information related to assets held for investment by a bank or similar institution that is regulated and supervised and subject to periodic examination by a state or federal agency, provided that the statements or information regarding these investment assets is certified by that institution. So the description of the scope of the audit comes first, as opposed to the prior limited scope audit, where the description showed up in the middle of the report. And now the description section is going to be followed by the opinion section, which will now be split into two parts. The first part will be the auditor's opinion on the information that is subject to audit. So instead of disclaiming an opinion, the auditor will indicate that the amounts and disclosures in the financial statements, other than those agreed to or derived from the certified investment information, are presented fairly in accordance with US GAAP. The second part of the opinion is just going to be an indication that the investment information agrees to or is derived from the certified investment information, and management believes that the certifying institution is qualified. So this is a very significant change, but ultimately it does provide more assurance on the financial statements relative to that limited scope audit that we're used to performing. And then following the opinion section, this audit report will kind of mirror that of the audit report prescribed by SAS 134. It will next include a paragraph on the basis for the audit opinion. It will include expanded discussions of management and the auditor's responsibilities for the financial statements. I think a noteworthy change here is that the management responsibility section is going to include a statement that management is required to evaluate whether there are conditions or events that could raise substantial doubt about the plan's ability to continue as a going concern. So again, similar to SAS 134 there. And this is also where management's responsibilities for administering the plan, determining conformance with plan provisions, and maintaining sufficient participant records are discussed. So the new audit report then will conclude with an other matter paragraph addressing required supplemental information. And just a final comment on this, if there's, you still do have the option of undergoing what used to be called a full scope audit. It's now called a non-ERISA Section 103A3C audit. The report for that is going to change also to mirror the audit report prescribed by SAS 134. It will begin with an opinion paragraph and it will not include the separate section describing the scope and nature. So other big impacts of SAS 136, I think another big impact on the auditors as well as management is a new requirement that reportable findings must be communicated in writing. According to this SAS, the auditors must communicate in writing identified instances of noncompliance or suspected noncompliance with laws and regulations, findings that are significant and relevant to those charged with governance, and indications of deficiencies in internal control that are significant enough, again, to merit management's attention. So the impact here, I think, is that more often than we're used to, the audit of a planned financial statement will be accompanied by a written management letter. Verbal communication of issues identified in the audit is no longer sufficient if it's deemed that those issues warrant the attention of management. So most likely going to see additional comments there on the management letter. Moving on, we can talk about the next SAS 137, the auditor's responsibilities relating to other information included in annual reports. So this is designed to provide transparency with respect to the auditor's responsibilities for other information included in an annual report. The goal here really is to provide clarity when a set of audited financial statements are included within a document that contains other financial or non-financial information that has not been subjected to audit procedures. So under this standard, management must now identify to the auditor in writing the documents that they would consider to be contained in their annual report. And the auditors are required to review that material to determine whether any information within is materially inconsistent with the audited financial statements. If the auditors do identify a material inconsistency, they will request that it be corrected, and they may withhold the audit report until they're satisfied that corrections have been made. If there is other information, the auditor will include an other information section in their audit report, which identifies that other information and indicates that it is the responsibility of management and is not covered by the auditor's opinion on the financial statements, but that the auditor is responsible for reading that other information and considering whether any material inconsistencies exist between that information and the audited financial statements. So to understand the implication of this standard, we have to look at what the language really means when it talks about an annual report. It's a very broad term in general, but it is defined within the SAS. So at the top of the next slide, an annual report is a document or combination of documents that is typically prepared on an annual basis by management or those charged with governance in accordance with law, regulation, or custom. The purpose of which is to provide owners with information on the entity's operations and the entity's financial results and the financial position that is set out in the financial statements. So in practice, this is going to refer to something like an annual board package that you might put together for the board to review, or maybe even if you publish a report on your website that has information about accomplishments and objectives and also includes the audited financial statements. That could be considered an annual report. So if your organization does typically put something like this together, it is important to communicate that to your auditors to ensure that they have the opportunity to review it and potentially add the additional paragraph within their audit report or customize it as needed. Other information, again, some of the things referenced within the SAS are board chairman or corporate governance annual statements, management, internal control or risk assessment reports, financial summaries or highlights, employment data, plans for a capital expenditure budget, or a document that contains financial ratios based on the audited statements. So anything like that, the auditors now will have to review and just determine that there are no material inconsistencies between that information and the audited financial statements. Moving on, we will briefly touch on the remaining SASs, going on to SAS 138, amendments to the description of the concept of materiality. So the purpose of this SAS is to amend the definition of materiality to be more consistent with the United States judicial system, the PCAOB, and the SEC. Unlike the other standards we've been discussing today, this one is actually not expected or intended to have significant impact on current practices. It's really just a change of the formal definition to match what's being currently practiced. Under the old concept of materiality, misstatements, including omissions, were considered to be material if individually or in the aggregate, they could reasonably be expected to influence the economic decisions of users based on the financial statements. The new concept of materiality is similar. It states that misstatements, including omissions, are considered to be material if there is substantial likelihood that individually or in the aggregate, they would influence the judgment made by a reasonable person based on the financial statements. So the new definition has its origins in a Supreme Court decision from dating back to 1976, where it was opined that an omitted fact is material if there is substantial likelihood that a reasonable shareholder would consider it important in deciding how to vote. So the new concept here is the introduction of the reasonable user. A reasonable user is, as defined in the SAS, as someone who has knowledge of business and economic activities and is willing to study information in financial statements with reasonable diligence, someone who understands that financial statements are prepared and presented and evaluated with materiality in mind, and a person who recognizes that there are uncertainties inherent in the measurement of amounts in financial statements because of estimates, judgments, and the uncertain future events. So again, just a change to align with other standards within the legislation and other governing bodies really should not have a significant impact on how audits are performed or what is considered material. So now to just briefly touch on the last few standards as an introduction. SAS 139 is going to amend certain sections of the FASB codification to be in conformance with other changes resulting from SAS 134. These changes affect reporting language for financial statements that are prepared under special purpose frameworks or are single financial statements or statements of specified elements or summary financial statements. AUC section 800 pertaining to financial statements under special purpose frameworks. The new standard requires that the auditor's report is now going to include a statement that these type of financial statements may not be suitable for another purpose. So just a clarifying statement there going into the auditor's report. AUC section 805, talking about single financial statements and audits of specified elements. The new standard addresses factors to consider when determining whether matters identified in an audit of the complete set of financial statements is going to be relevant to that audit of the single statement or specified element. AUC section 810 talks about summary financial statements. The change here just clarifies that the auditor's report on summary financial statements is not required to address the key audit matters that may be used in the set of full financial statements. SAS 140 is very similar to SAS 139 in that it's just giving additional updates to other specific accounting standards to align with the new reporting standards. AUC sections 725 and 730 are amended to require the reporting on supplementary information to be in a separate paragraph of the auditor's report rather than in an other matter paragraph. Changes to AUC section 940 apply to integrated audits of internal controls and financial statements. So really mostly going to apply to public companies. It requires that when a separate report on internal controls over financial reporting is issued, it needs to align, it needs to make a reference rather to the report on the financial statements and vice versa. The report on the financial statements must reference the report on internal controls. Section 930 is amended to change reporting requirements with respect to reviews of interim financial information. And finally, AUC section 835 is amended to achieve consistency with the uniform guidance in a couple of areas. It's going to include now a requirement that a combined report on compliance and internal control be prepared as the default practice. So instead of having separate reports on internal control and compliance, the default is now that those are going to be reported in a single report. There's also going to be an amendment that changes the definition of material non-compliance to align with the new description of materiality that is prescribed by SAS number 138. Now our final SAS is SAS 141. Again, as we discussed at the outset, this is really just issued to formally amend the effective dates of SAS 134 to 140 to provide a more time for accounting firms and their clients to implement the standards as a result of all the interruptions we've had due to COVID. Again, these standards will be effective beginning December 15th, 2021. So any fiscal year ending after that date. So that will be effective for upcoming audits for December 31st, 2021. The SAS also does lift the prohibition against early implementation. So if you have not yet commenced your audit for the December 31st, 2020 year end, and you wanted to early adopt these standards, you are permitted now to do so. And again, as John discussed, the intention is that all of these standards will be implemented simultaneously. So that concludes our review of the new audit reporting standards. Certainly there's a lot of detail here and a lot of information included in these standards. We do hope that this provided a good introduction. I think the most significant changes that you're going to see in practice coming out of this is going to be that change in the format of the auditor's report, both in regular financial statement audits and the audits of the employee benefit plans. And also there will be, some new questions that are going to be asked. So if you're interested in reading further into these changes, I would recommend going straight to the source. The SAS CPA has published all of these standards, and they do highlight within the standards the updated guidance. In particular for SAS 134 and 136, they do include a full example of what the new audit report format looks like. So as you're preparing for implementation, that's a great resource. And if you're getting ready for these standards, if you're an auditor, it really is important to get comfortable for these in advance of those December 31, 2021 audits. You want to develop a new template for the audit reports, update your list of standard inquiries for governance. For management, I think it's useful to review these just to get familiar and know what to expect when the auditors come in, because there will be some new inquiries around these significant unusual transactions and related parties. And with regard to the benefit plans, certainly make sure you have those plan documents up to date and readily accessible. Make sure your investment provider is able to provide that certification that's required for the ERISA Section 103A3C audit. And for management, one other thing that I think should be considered before engaging the auditors is whether you want to talk about those key audit matters, because again, that requirement it's not going to be a requirement by default. You do have to engage the auditor specifically to include that section, and depending on your situation, that could add a lot of benefit and context to your audit report. So just something to think about there. We do thank you all very much for your attention today. We are happy to address any questions you may have, and hope everyone has a great afternoon.
Thanks, Max. I did receive a few questions through the chat, the Q&A. The first question I have is, are we required to disclose key audit matters in our audit reports?
Thanks, Tom. I'll take this one. Are you required to disclose them? No. The answer is no. So for private companies, CAM is only presented when the auditor is engaged to do so. And so it's inherently an additional service, but it can be used to highlight significant areas within the audit engagement. They should be entity specific and should not be something that would apply to a different client or a different auditee. And they're there to provide more transparency in the audit rather than just a pass-fail opinion model. And it's important to remember that CAMs are included in the audit report itself rather than a separate letter like a governance letter or a management letter. So any financial statement user will be able to see the CAMs that are disclosed.
Okay, and going off that, John, I have a similar question in the Q&A. If the client requests key audit matters and they are documented in the engagement letter, is the auditor required to list at least one CAM?
Thanks, Tom. So if management has decided that they would like to include key audit matters in their report and it is documented in the engagement letter, then it sort of becomes like any other audit matter. There'll be discussions between the auditor and management to discuss the key audit matters that are proposed. Again, it would be anything that is significant or important to the audit. If it's agreed upon by both sides, then it would be included. Otherwise, you could include things that are already being disclosed in the governance letter, such as key estimates, significant financial statement disclosures, or anything else of that nature.
Thanks, John. Another question I have is, when should one use the ERISA Section 103A3C?
So when you do that ERISA Section 103AC3 audit, the context really is somewhat parallel to the current situation where you can engage an auditor to perform a full scope or a limited scope audit. And so you really have to ask yourself whether you have an investment provider that you are confident in, that can prepare accurate schedules, and that is willing to make that certification statement as to the completeness and accuracy of all investment information. The biggest change there is that instead of just having, the auditors make the statement that they looked at the certification and that's why they didn't perform procedures over the investment, there is now going to be a management responsibility to also agree that they believe that the certification and the investment provider is giving accurate information. So that's really the only change. I still do recommend using that ERISA section 103 AC3 audit like you would use a limited scope audit, because it does potentially save time and a little bit of cost for the audit because there's going to be less audit procedures required. But there is now an additional step that has to be performed by management there.
Thanks, Max. Another question I have is, can you please expand on the new going concern requirements?
Yeah, thanks for that question. So the new standards do require and assign increased responsibility to both management and the auditor around the evaluation of going concern. The report now explicitly assigns management the responsibility to evaluate whether conditions or events are present that may give rise to the entity's ability to continue as a going concern for a reasonable period of time as defined by the applicable reporting framework. And then it assigns the auditor the responsibility to conclude on if those conditions actually do give rise to a going concern issue. And so if a going concern issue is identified, then a separate report section will be required. And this section will disclose the conditions that have been identified as well as management's plans to alleviate or deal with those conditions.
Great. And the last question I have is, what is the most important thing to prepare for the new standards?
If we're talking about, from management's perspective, I think the communication and awareness of these standards in itself is the most important thing, because we just don't want to have anybody encountering, unpleasant surprises during the audit when they see words like substantial doubt about going concern, or, questions about difficult or contentious matters or significant unusual transactions. Terms like this can sound, intimidating on their face. But if we communicate, throughout management and also up to our audit committees that, we should expect to see some new questions and some changes in the wording, that so no one gets caught off guard. I think that's important. And, for anyone who's in practice, definitely get those new audit reports tied down and understood, and be prepared to implement those once you get into your busy season next year.
Awesome. Thank you, Max and John. With that, we'd like to thank everyone for attending today's discussion. We encourage you to follow us on social media at GRF CPAs and visit our website, www.grfcpa.com, for upcoming events and alerts. Please remember to complete the survey that will appear automatically following the session if you would like to earn CPE credit for attending today's discussion. Thank you again and have a great day.